Welcome to the deep dive. Today we're tackling something I think we've all thought about. Why do we all have such different, sometimes really baffling views on money?
Yeah.
What seems like a totally obvious financial move to you might feel completely wrong to someone else.
It's fascinating, isn't it? Because what looks like, just crazy financial behavior
Uh-huh.
often makes perfect sense once you dig into the background, the context.
Right. Have you ever just looked at someone's spending or maybe their saving habits and just thought, why on earth would they do that?
Oh, absolutely. All the time.
Constantly. And that's exactly what we're getting into today. Our mission here is to sort of unpack the real reasons behind all these different financial outlooks.
Okay.
We'll be exploring how our own personal histories and maybe the generations we grew up in profoundly shape how we relate to money.
And this whole exploration, it's really drawing from the insights in the psychology of money.
Exactly. So have you ever wondered why someone you know, or maybe even you, makes financial choices that just leave other people scratching their heads?
Yeah.
Well, this deep dive should shed some light on those, well, those hidden drivers.
And a really key idea from the book is this. Your whole financial worldview, it isn't built on just pure logic.
Okay.
It's deeply personal. It's molded by the specific economic times you actually lived through.
Yeah.
Everyone's journey with money is just unique,
Right.
shaped by your generation, how you were raised, the economy when you were, say, coming of age,
Uh-huh.
the job market you walked into, maybe even just pure luck.
Okay, let's unpack that a bit. Think about risk, for example, how we view risk.
Yeah.
Someone who grew up, maybe in poverty, where every dollar counted.
Right.
They're going to have a fundamentally different take on financial risk compared to someone raised with, well, plenty of money and a strong safety net.
The emotional weight is just completely different.
Totally.
And then there's inflation. Think about that. If your formative years, maybe late teens, early 20s, when you're first really paying attention to money, if those years had rapidly rising prices, you probably developed a whole different set of financial instincts.
Different than someone who grew up when prices were stable.
Exactly. One group might think, spend it now before it's worth less, while the others focused on, long-term saving.
And that's related to that anchoring idea, right?
Yeah,
Your early experiences set a kind of baseline.
precisely. They create this lasting reference point that's hard to shake.
Okay, this is where it gets really interesting, I think. The book uses the stock market as a great example.
Yeah.
Someone who was in their teens and 20s, say in the 1970s,
Okay.
they saw a stock market that, well, after you account for inflation, basically went nowhere for a long time.
Right. Flatlined in real terms.
Now, contrast that with someone coming of age in the booming 1990s.
Oh, yeah. Totally different picture.
The market just seemed to go up and up. Those two people, they're going to develop very different gut feelings about stocks.
And different long-term beliefs about what the market even is capable of.
Exactly.
And the really crucial point here, the book stresses this, is that these different views, they're not about who's smarter
Right. Not intelligent.
or who has better information. It's about these deeply ingrained personal histories that literally shape how you see the financial world working.
It's kind of mind-blowing when you think about it that way. The book points out that our own experiences with money,
Yeah.
while they feel huge to us, are actually just this tiny, tiny fraction of all of financial history. Like 0.0000001% or something ridiculous.
And this is the kicker. That tiny personal slice might dictate something like 80% of how you think the entire world of money works.
Wow, 80%.
Yeah, and that's why you see these incredibly smart, well-informed people holding completely opposite views on big financial questions. Like, are we heading for recession? What's the best way to invest? How much risk is okay?
It explains so much disagreement.
Totally.
It's so true. The book even mentions Frederick Lewis Allen talking about the Great Depression,
Right, the lasting impact.
how it just left this permanent mark on millions. But even within that huge event, people's actual experiences varied wildly.
Leading to a whole spectrum of financial attitudes in the generations that came after.
Okay, so individual experiences shape our views. Now let's go a bit deeper into how these experiences, especially when we're young adults, can create these sort of lasting anchors for investing.
Yeah, this anchoring effect is really powerful in investing. There's economic research backing this up that what you experience in your early adult life heavily influences your investment choices for, well, basically your whole life.
Okay, can you give us some concrete examples? What does that look like in practice?
Well, the research suggests, for instance, if you grew up when inflation was really high,
Uh-huh.
you're likely to put less money into bonds later on compared to someone whose formative years had low inflation.
Because you learn that inflation eats away at bond values.
Exactly. And conversely, if your early adulthood lined up with a really strong stock market,
Like the 90s kid we mentioned.
right, you're probably going to be more inclined to invest more heavily in stocks throughout your life. Those early lessons just stick.
That makes total sense. It becomes your default setting almost.
Pretty much. And the economists the book cites, they conclude that how much risk an individual investor is willing to take. It's not just about smarts or education.
Okay.
It's significantly shaped by their personal history. They actually call it the dumb luck of when and where you were born.
Wow. Dumb luck. That's quite a phrase.
It is, but it highlights how much is outside our control.
The book even mentions Bill Gross,
Right.
the big bond guy.
Yeah, the bond king.
He apparently acknowledges that his hugely successful career happened to coincide with this massive decades-long fall in interest rates.
Right, which was a huge tailwind for bond prices.
And he basically says if he'd been born 10 years earlier or later, things might have looked very different for him.
Even the giants recognize the role of timing and context. It shows it's not just about individual genius.
So these generational experiences, they don't just affect our choices, they shape how we even see the investments themselves.
Absolutely. For someone like Gross, bonds were these amazing wealth generators.
Mm-hmm.
But maybe for his father's generation, who saw high inflation,
Right.
bonds might have looked like, I don't know, wealth incinerators.
Well,
Guaranteed way to lose purchasing power.
complete 180 in perception,
Oh,
just based on when you lived.
exactly.
And the book really hammers this home with S&P 500 returns, doesn't it?
Yeah, those examples are striking. If you were born in the 1970s,
Okay.
by the time you were in your teens and 20s, the S&P 500 adjusted for inflation had gone up almost tenfold.
Tenfold. That's
Yeah.
massive. That would definitely shape your view of stocks.
Hugely positive reinforcement. Now, compare that to someone born just 2 decades earlier in the 1950s.
What was their experience?
During their equivalent years, those teens and 20s, the market basically went nowhere in real terms. Flat.
So zero reinforcement there. Maybe even negative.
Right, so you have two equally smart people, just born 20 years apart, likely developing fundamentally different core beliefs about how the stock market even works.
And you see the same thing with inflation, right? Someone born in the 60s saw big price jumps early on.
Very different experience than someone born later when things were more stable. It just anchors your expectations differently.
Okay, so this whole framework,
Yeah.
it really starts to make sense of why we look at someone else's money choices sometimes and just think, that's nuts. That's completely irrational.
Exactly, but the book really pushes us to pause before judging
Yeah.
and consider, well, what might their underlying experiences have been? What lessons did life teach them about money?
That takes effort, though. It's easier just to think they're being weird.
It is easier, but less useful. Take the example the book uses of people with very low incomes buying lottery tickets.
Okay, statistically terrible odds.
Yeah,
Bad financial move.
absolutely. From a purely rational spreadsheet perspective, yes. But the book offers this really powerful counter-perspective. For some people, that lottery ticket might represent the only tangible way they can imagine achieving a dramatically better life.
Ah.
A life that maybe others, people with more resources, just take for granted they can work towards.
So they're not just buying a tiny chance.
They're buying a dream.
Hmm.
The feeling of possibility, however remote, it's an emotional purchase, not just a financial one.
That really does change how you see it.
Yeah.
Puts it in a different light.
It reminds us that so many financial decisions aren't just made with a calculator.
No.
There's this whole mix of other things swirling around your personal history, sure, but also ego, pride, maybe marketing you've seen, weird incentives, all shaping the stories we tell ourselves about money.
Okay, that makes a lot of sense. And there's another big piece to this puzzle the book brings up,
Yeah.
which is how surprisingly new a lot of modern finance actually is.
Right. That's a crucial point. Money itself is ancient, obviously.
Yeah, millennia.
But the way we manage it today, saving, investing, retirement planning, a lot of these core concepts are really, really recent inventions.
Okay, like what? Give us an example.
Well, retirement is the big one. The whole idea of most people stopping work and living comfortably for years. That's maybe only 2 generations old as a widespread expectation. Before World War II, the norm for most Americans was basically work till you drop.
Wow, That's a massive shift in thinking in a relatively short time.
Huge. And even Social Security, when it started, the benefits were pretty minimal.
Not like a full pension?
Not at all. It was a basic safety net. Poverty among the elderly was still really high until like the late 1960s.
And the idea of companies providing pensions for everyone.
Mostly a myth before the 70s, according to the book. It wasn't that common.
So this whole system we have now where individuals are largely responsible for saving and investing for their own retirement, that's new territory.
Pretty much brand new, historically speaking. Think about the 401k.
Okay.
Cornerstone of U.S. retirement saving for millions, right? It didn't even exist until 1978.
78, that's really recent.
And the Roth IRA, even newer,
Wow.
1998.
Good grief.
The book jokes that if the Roth IRA were a person, it would barely be old enough to vote.
Huh. Okay, that puts it in perspective.
So maybe it's not that surprising that so many of us feel like we're struggling or making mistakes with saving and investing for retirement.
Because we're all kind of newbies at it.
Yeah,
The system itself is young.
exactly. We're all navigating this relatively new setup without generations of accumulated wisdom to draw on.
That's a really important point. We're working with tools and ideas that just haven't been around that long.
And it's not just retirement. Think about college.
Okay.
The huge jump in how many people go to college and the absolutely skyrocketing cost of tuition.
Yeah, that's happened fast too.
Relatively speaking, yes. So
Yeah.
maybe that helps explain some of the difficulties and, well, poor decisions people sometimes make around student loans.
Because there's no long history, no collective experience to learn from easily.
We're all kind of figuring it out as we go, in real time.
And the book mentions other things too, right? Like index funds.
Yeah, relatively recent, widespread consumer debt mortgages, credit cards as just a normal part of life. Also, quite new in the grand scheme of things.
Quite a contrast.
Right. The book makes this funny comparison to, like, dogs.
Dogs.
Yeah, domesticated thousands of years ago, but they still have behaviors left over from their wild ancestors.
Okay.
Yet here we are, with maybe just a few decades of real experience in this super complex modern financial system,
Oh.
kind of expecting ourselves to be perfectly rational and adapted to something that's often driven more by emotion and these recent historical quirks than pure logic.
So putting it all together,
Yeah.
when we see financial behaviors that looks crazy,
Yeah.
it often comes down to a combination of two things. Our own unique, deeply ingrained personal history lessons.
Uh-huh.
And our collective kind of awkward inexperience with this relatively new world of modern finance.
That really nails it. That's the core message, I think. Our individual stories and the times we grew up in, they just fundamentally shape our financial outlooks. And that inevitably leads to behaviors that might look contradictory or irrational from the outside, but make perfect sense within that person's own context.
So it really drives home that point from the book. Nobody is actually crazy with money.
No.
Right.
Our choices are rooted somewhere. They come from our experiences, the lessons we learned, right or wrong.
And knowing that, it should really encourage a bit more empathy, shouldn't it?
Ideally, yes. When you see someone making a financial choice, that just seems baffling.
Yeah.
Try to step back, trying to think about their background, the economy they grew up with, the lessons life might have taught them.
It's a different way to approach those conversations, or even just your own thoughts about it.
Definitely.
So maybe here's a final thought for you listening. How could understanding these generational anchors, these personal histories, how could that help you understand your own financial choices better?
Yeah, that's a good question.
And maybe, just maybe, it could help bridge the gap when you talk about money with other people in your life.
Could make those conversations a bit easier, perhaps.
Right. Think about it. What financial behavior, maybe yours, maybe someone you know that seemed crazy before, might now seem just a little more understandable?
Because that understanding, as this whole deep dive suggests, that could be the really crucial first step towards having more effective and honestly more empathetic financial discussions.